Next, class 11. Class 11 reaching the next adjustment, the 17th adjustment in our textbook. This is page 22.42 in my textbook. The 17th adjustment is called deferred revenue expenditures. You understand the meaning of revenue and expenditures? Revenue means those expenditures that are incurred on the operation of the business. It is not one-time business activity, it is not one-time expenditure, but regular use expenditures. Those expenditures that are incurred for operating, the operating expenses for operational purposes. Those expenditures are called the revenue expenditures. And what is deferred? Deferred means spread. The literal meaning of deferred is spread. So those revenue expenditures that are spread over a period of time. Now, why will the expenditure be spread over a period of time? Because children, these are those type of expenditures which are incurred once, but the benefit of these expenditures, benefit of the deferred expenditures is received in the years to come. Like the best example of deferred revenue expenditures is advertisement. Now, if you understand, so the best example I told you to understand the deferred revenue expenditures is advertisement. What is advertisement? Advertisement means the amount that is spent. It is not one-time expenditure, so we cannot call it capital in nature. It is not capital in nature. It will be wrong to call it capital. So what is it? It is revenue expenditure. But is it important or is it necessary that the amount that is being spent to generate the profit, this amount, because that is why it is revenue, this amount that is spent as revenue expenditure, that is spent every year, do the companies or big companies, they make advertisement, huge advertisement campaigns are made, they are prepared, but it is not necessary that these campaigns need to be redone every 12 months. No, maybe big amounts are spent, maybe 1 crore. A big company has spent rupees 1 crore on advertisement campaign. Does this 1 crore that has been spent on advertisement campaign, does this give benefit to the company only for 1 year? No, the company has made itself aware to the public with this 1 crore, which is going to give benefit maybe in the next 5 years. So that means for this amount, the amount that has been spent, the income will be generated in the next 5 years to come. So it is not justified, children, to charge this entire 1 crore of as an expense only in the first year. It is not justified, it is not right. So what do we do? This 1 crore, that means this 1 crore is going to give us benefit in next 5 years. So it will be wise to divide this in 5 years. In 5 years, that means rupees 20 lakh each year. 20 lakh each year. So this 20 lakh will be the revenue expenditure of the current year. And what about from the 100 lakh, 20 lakh from this 100 lakh that has been spent on advertisement, this has been spent. And how much relates to 1 year? Only 20 lakh relates to 1 year. Then what about the remaining 80 lakhs? 80 lakhs will give us benefit in the years to come, in the next 4 years. Out of this 100 lakhs, this is going to give us benefit in 5 years. 20 lakhs is going to give us benefit in this year. Remaining 80 lakh will give us benefit in the next 4 years to come. So we will charge every year, we will charge only the amount that is giving us benefit this year as an expense of the current year. Rest will be taken as asset. So rupees 20 lakh that is the expense of this year, will be shown on the debit side of P&L account. P&L account. The expense for this year is going to be shown as expense on the debit side of P&L account. And 80 lakh, which is giving us benefit in years to come, next few years to come, that is an asset. So the 80 lakh will be shown as asset on the asset side of balance sheet. This will be the accounting treatment of this 100 lakh. Okay, so that means I wind up here. For the deferred revenue expenditures, the amount of the current year, the expenditure of the first thing is the entire expenditure is divided in the years, it will give us benefit. The current year's expenditure will be treated as expenditure in the current year and shown on the debit side of profit and loss account. And the remaining amount of, out of 100 lakhs, 20 lakh is expenditure. Remaining 80 lakhs will be shown on the asset side of the balance sheet as an asset. This is the treatment of deferred revenue expenditures. See here children, this is illustration 14 of your textbook. I'll show you the concerned part. Illustration 14 shows, this is the trial balance. The extract of trial balance has been given. Advertising, I've underlined here. Advertising has been shown for rupees 6,000. 6,000 has been shown as advertising. The amount that is spent on advertising this year is 6,000. How much relates to this year? Let us see. This is the trial balance, this year's expenses, recording the expenses and the incomes of the current year. Now adjustment reads, write off 1/5 of advertising expenses. Okay, 1/5 has to be written off. That means 1/5 of what? The advertisement expenditure, the advertising has been spent is rupees 6,000. The amount spent on advertising is rupees 6,000. And they say 1/5 has to be charged as expense this year. 1/5 of 6,000. So that means rupees 1,200 will be shown as expense this year. And what about the remaining 6,000 has been spent, 1,200 is expense of this year. So what about the remaining 4,800? That will be shown on the asset side of balance sheet. Let us see the accounting treatment here. See, the accounting treatment here shows advertising 1/5 of 6,000, that is rupees 1,200. Out of the total amount of that is spent on advertising, 1/5 relates to this year. So that 1/5 is going to be shown as the expense of this year. What about the remaining 6,000 minus that 1/5? Rest 1,800, rest 4,800 is shown on the asset side of balance sheet as the unwritten off portion of advertising. Advertising expenses 4,800. Clear? This is deferred revenue expenditure. Now next, after this, the next is manager's commission on net profit. A very important adjustment to understand. I want you to read these lines. Sometimes, in addition to his regular salary, the manager is entitled to a commission on net profit. This is done to induce him to take more interest in business. Since the commission is always calculated at the end of the accounting period, it is treated as outstanding expenses and the following adjustment entry is passed. Commission account to outstanding commission. See children, what is done here? Here children, now manager's commission, as you just have read in the textbook, manager, who is a manager? Manager is the person who is not the proprietor of the business, but he carries on. He is the person who is taking all the important decisions to run the business. he may not be the owner of the business. If he is the owner, yes, he does take interest in the increase of the profits. His decisions are very coincidentally matching the decisions of the manager. But yes, in case he is a hired officer, a hired employee of the owner for the business, he may not take deep interest in increasing the profits because it is not personally associated with he is getting his regular salary. He is the hired employee like other employees. He is also receiving his annual salary, his regular salary from the business. So what is done to give an incentive to the manager so that his decisions are matching the profits of the business? His decisions lead to the increase in the profits of the business. He is given a commission directly proportional to the net profits. So we tell him that whatever, if you earn 1000 as net profit, you will get 10% on 1000, means you will get 100. If you earn 2000 as net profit, you will get 10% of this, you will get 200. If you earn 10,000 as net profit, you will get rupees 1000. That means as the amount of profit is increasing, his commission also is increasing. This commission is besides his regular salary. This is plus his regular salary. He is getting his salary as an employee of the business. Over and above the salary, he is getting this commission, so that he takes personal interest in taking such decisions that increase in the profits of the business, that generate profits of the business. Now the profits can be calculated, or his commission. First, let me tell you the treatment of the commission. Commission is an expense to the business. Whatever we are giving him as salary, that's an expense. So this commission that we are giving over and above the salary, this is also an expense. And like all other expenses, this also will be shown on the debit side of profit and loss account. Secondly, this commission, children, otherwise all the expenses, rent, electricity bill, anything, salaries, wages, everything has been paid till the last date of the year, 31st March, everything is cleared. But profits are calculated only at the end, after taking all those expenses in consideration. So when this commission is based on those profits, we'll have to wait for the profits to be calculated. So generally this manager's commission is outstanding, so will be charged as outstanding commission. This is outstanding commission, and this commission is calculated in two ways. There are two ways to calculate the outstanding manager's commission. This can be calculated on net profits. Which net profits? Before charging these commission, before charging this commission, before charging such commission, or on net profits where the commission has been charged, because this commission that is going also is an expense. So if we take this expense, then this also, how do we charge this? We will have to find a formula for this, or after charging this commission. Either of the way can be taken. The calculation formula for manager's commission will be, if it is given manager is being paid commission on net profits before charging this commission, then on the net profit he gets the decided rate. Suppose it is 10%, rate upon 100, 10 upon 100. Supposing it is given manager is to be given commission on net profits after charging this commission, then it is assumed net profit into rate upon 100 plus rate. That means supposing it is 500 upon 105, 100 plus rate. Supposing it is 10 upon 110, supposing this is 20 upon 120. So whatever is the rate of commission, rate plus the 100 plus rate will be denominator. This will be the calculation of commission. And how will this commission be treated in the accounting treatment? It will be taken at two places: debit side of profit and loss account and liability side of balance sheet as the outstanding commission. Why outstanding? That also I've told you, because it is paid after all the expenses and incomes have been cleared in the financial statements, and it is calculated and also debited on the debit side of P&L accounts. Clear? Now we'll see the coinciding question. Only this part I'll show you. This is illustration 15 in the textbook. All these expenses have been given. This manager's commission will always be given as an adjustment. It will not be given inside the trial balance. There is no chance. The manager's commission, the last adjustment reads, provide manager's commission at 10% on net profits after charging such commission. What is important is after charging such commission. After charging such commission means the formula was net profit into rate upon 100 plus rate. And what is the rate? Rate is 10% here. That means 100 in net profit into 10 upon 110. So we calculate the net profit. We make the profit and loss account, trading account, profit and loss account. Supposing this is the profit and loss account. All the expenses to rent, to salaries, by discount, by gross profit, everything, all these things have been taken here, and we come to this net profit. This is the net profit. This net profit we are taking to calculate. In this net profit, now on this net profit we will charge the commission. Before you close the books of accounts, this manager's commission will be taken as will be calculated net profit into 10 upon 110. 10% is the rate taken here. On this we calculate net profit without taking this commission. This commission is calculated and also shown as an adjusting entry in the extended P&L account. See here, advertising, they have been given here. All the other expenses have been taken. You take all the expenses, and then they say in the end, commission to manager at 10% on profit after charging such commission. We will calculate the manager's commission. All these expenses and the incomes will be taken, and the profit will be calculated. The gross profit is calculated with the gross expenses, gross profit, all the other expenses are taken, calculated, and we come to the balance, the being the profit before charging manager's commission. This is 57,805. This is the calculation, 57,805. This is manager's commission has not yet been taken. It has to be taken after charging such commission on this net profit. You will calculate the net profit as you have been doing. Then the extended part will be this 57,805 into rate upon 100 plus rate, in case it is after charging, or in case it is before charging, then 10 upon 100. We will calculate and also take it on the debit side. This is extended P&L account. And then that means out of the net profit you calculate before this commission has been taken, you calculate the commission on that net profit, or isme say you will subtract this also. This also will be subtracted from the net profits. Net profit will be calculated and will be subtracted. This is the net amount that will have to be shown as the net profit, as the commission, manager's commission. And in the balance sheet, the manager's commission will be shown at the decided rate, the calculated amount 5255, and the capital will be added after that. I hope this is clear with this question. Now girls, the coinciding unsolved question at the back has to be updated in your notebook. All the questions following the chapter, I am doing the questions with you. Those questions that are not covered till now, or I have not done with you without any special instruction, all the unsolved questions have to be updated in the notebooks. The first day we meet in school, the notebooks will be checked for all your unedited works. Okay, thank you girls.